Wanted to do a short video on the 2008 recession, basically the real estate crash. Go over the details of basically what caused the crash and what the government did to take the U.S. and actually the whole world out of the recession after reviewing more than a dozen articles on the 2008 real estate crash and the steps taken to take the economy out of the bucket. I kind of noticed that not one of them covered 1/10 of actually what happened. So I'm going to relate a few personal stories because I just started in real estate. I went through it. I saw exactly what was happening firsthand and what caused it. So I'll share a couple of ideas on that. And without any further ado, let's get into it. I took some screenshots off of some articles I found on the internet. And you can search out the information on the internet yourself. So if you want to do a little bit more digging, if you want to leave a comment, do so. Basically, what we want to do is cover some of the major facts. The Great Recession began well before 2008. Okay, there were signs showing that something was happening, and the Federal Reserve responded to the subprime mortgage crisis by adding $24 billion in liquidity to the banking systems. In other words, the Federal Reserve is a branch of the government that makes really low interest rate loans to the banks, and then the banks loan it to people like us, and make a profit out of it. Okay, by October 2008, Congress approved a $7 billion bank bailout. Okay, this is back in 2008. Now known as the Troubled Asset Relief Program. There were quite a number of bailouts that took place, so we'll cover the big ones, the important ones. Okay, by February 2009, Obama proposed the $787 billion economic stimulus package, which helped avert a global depression. Here's an overview of the significant movements of the Great Recession. In other words, we just went through a recap. Okay, key points. The Great Recession began with the subprime mortgage crisis in 2006 when banks invested in mortgages in the form of derivatives. Okay, basically, what does that mean? I'm just going to go back and relate to what I've seen in a particular market I was dealing with in Milwaukee, which was, kind of the market with the lower priced properties. Within a year, I saw properties go from $50,000 and $60,000 to well over $100,000. I mean, it was like every single week you would see a jump in prices, and to me it kept on going. Well, why should I tell a buyer to buy this property for $80,000 that was $60,000 last week? And the prices just kept on going up. And there were other issues involved that I'll cover later with how qualified were some of these buyers. Okay, subprime borrowers started defaulting when the housing bubble burst. At the same time, the Fed raised rates. Okay, so basically, the Fed raised interest rates, and that was one of the major causes of the housing depression, housing recession, whatever you want to call it. Okay, too big to fail banks, hedge funds, and insurance firms found themselves holding worthless investments. If you remember, there was, none of these articles really cover it, but there were banks that were taking federal funds they were supposed to lend out, and instead of lending that money, they were investing it in the stock market in hedge funds that were supposed to be holding all of this real estate investments and stuff, but there were a lot of problems. Number one, there were loose regulations on appraisals. So I've seen it happen. Basically, this is how it happened. Realistically, take my word for it. Real estate agents and lenders would tell the appraiser that it has to appraise for this amount, like $120,000. Well, the appraiser, last month was just appraising these properties for $75,000, and now the appraiser is told to appraise it for $120,000, so the loan will go through. That actually happened. I've seen it happen. I didn't agree with it. I had nothing to do with it. As a matter of fact, I pulled out of so many deals. I led the league back in those days in cancellation mutual releases, pulling buyers out of bad deals to where the property was just overpriced. And actually, it was kind of a rough thing for me because I was not taking advantage of the loose laws, or basically back then the non-existent laws. And since then, the government has passed a lot of laws. To be a licensed appraiser, you have to follow a whole bunch of federal regulations and all of this stuff. And so they've tightened up the appraisals. Okay, the stock market crashed in 2008, and the Dow registered one of the largest point drops in history. So basically, what's that telling us? We see the stock market starting to go down, and is that a sign? Well, we have to put this back in perspective. What was the big stock drop back in 2008? It was the banks investing in, realistically, one bank would invest in and buy up stock that was supposed to be supported by real estate. Okay, so there was equity or whatnot. Well, none of these properties had any equity in them. They were overappraised. They were fake appraisals. And the smartest people running the largest corporations in the United investment corporations, these were supposed to be the investment experts, were making poor investments. They knew they were holding all of these notes on properties that, were worth maybe 40, 50, 60% of what the paper said they were worth. Oh, but it was okay to trust another banking or investment firm that I'm sure they do everything perfectly legal. Well, this is really what caused it. Is the smartest investors in the world made bad investments. And then, of course, Congress started passing all kinds of acts, stimulus packages, all that kind of stuff. Were they good? Were they bad? Well, we'll take a look at a couple of these. Okay, these interest-only loans were offered to some subprime, high-risk borrowers who were likely to default. The banks offered them low interest rates, but those too good to be true loans reset to a much higher rate after a certain period. Home prices fell at the same time. Okay, basically, this is how it worked. And this was a real problem. It was smaller lenders. Okay, there were small lenders all dotted all the way across. I mean, this was like, payday loans I can kind of compare it to. So a bunch of people got their lending license, opened up an office, and they were mortgage brokers. In other words, they didn't have a dime to lend anybody, but they worked with other mortgage companies. And of course, they had they kept on telling the people, I'll get the best deal I can for you. I'm working for you, blah, 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 the whole bit. I mean, yeah, okay, does that sound like a line from scammers? Yeah, of course it was. People were getting scammed. They were getting them into interest-only payment loans and adjustable rate mortgages. And we know that's only for what? 1 year, 2 year, 1 year, 3 year, 5 years. They would have the lower interest rates, and then the interest rates would reset to market value. Well, there were also things going on, and it's still a good idea today. They buy down the interest rates. But what they were doing, instead of buying down the interest rates for the life of the loan, they were buying down the interest rate for the first year, or the first 2 years, or the first 3 years, and then after that, your discount went away. I'm beginning to see that again. So basically history is repeating itself to where a buyer will pay an extra, let's say $4,000, buy down the interest rate on the loan for the first 2 or 3 years, and then have to pay higher interest rates, hoping that they're going to be making more money in the future and be able to pay it. So this is just starting over again in 2023. So we got to watch out for these signs. I mean, I'm seeing history repeat itself again. Oh, and on the buy down, when I was working at it, what I saw, and I've seen it a couple of times in the last couple of years, I do not like working with buyers who don't have the money in the bank. In other words, if they haven't exhibited to me the ability to save money, I'm a little reluctant. I'll have them talk to one of my trusted lenders who does credit repair and everything else, and he'll run them through everything and take a look at their credit history, how much money they owe on charge cards, student loans, car loans, and all the other stuff, and start counseling them on how to get their credit score up so they can be a legitimate buyer. I mean, I've had, back in those days, close to about 100 sales over those years, and out of those 100 sales, 0 foreclosures. None of my buyers went into foreclosure. One of them went into a loan reconstruction. He called me, says, hey, I need information, and I need it from a licensed real estate agent, and I sent him the reports, and he got the loan restructured. And then there was one other instance I heard of I helped a buyer get a house, and then his mother was having problems. She got her loan restructured, and I got the information over to the bank to go through and make an assessment on that. So, 2007, the Fed didn't do enough to prevent the recession. Okay, what was wrong with it? Okay, so basically they needed lenders to work out loan arrangements rather than foreclosure. Now, you would think it's in the best interest of everybody, and I'll tell you right off the bat, I've seen a lot of smaller banks more than willing and work their butts off to restructure a loan to keep people in the houses. That's the smaller banks. But the major corporations, hell no. They had their rules, they had their regulations, they have, entire office buildings that are 16 stories high just for their attorneys. And there were incentives with mortgage insurance and everything else to where the banks actually made more money by foreclosing on a house taking the house back at the sheriff's auction and then reselling the property as a foreclosed property. I did the calculations on that. Unfortunately, the laws and everything that the government did, unfortunately, were more aimed at favoring the major bank corporations rather than the average American homeowner. So converting the loan to a fixed rate mortgage and receiving credit counseling. Now that's important. I mean, basically, if someone's going to make a mistake, send them to a counselor, find out how they made the mistake, and make sure they have the knowledge so that they do not repeat that mistake. Makes sense. So basically, the banks that worked with these foreclosure situations would receive Community Reinvestment Act benefits. I got no idea what that one is, but I know there's mortgage insurance and all this other stuff that the banks were getting paid. Okay, in September, the Fed began lowering interest rates. By the end of the year, the Fed funds rate was at 4.2%, but the Fed didn't drop rates far enough or fast enough to calm the markets. This is back in 2007, and we know they lowered the interest rates way below this 4.25%. But what did they do to combat the housing recession? They lowered interest rates. Okay, let me ask you a quick question. You've been watching the news over the past 2.5 years. What has the Fed been doing? Raising interest rates. And what have we been hearing warnings about? Another housing recession. So, I got a kind of question on how the Fed plans on fixing this forthcoming housing recession by doing the opposite of what they didn't do far enough or fast enough in 2007. So there's just some information to chew on. Okay, in July 2008, the recession began. Okay, why? The GDP fell by 2.5%. Okay, that's the gross domestic product. That's basically what the United States is producing, and a big part of it is what the United States manufacturing sector is producing and selling to other countries, and that also includes the service sector, software or whatnot. But, how much is this government investing in the average American worker to produce something to sell either in the United States or overseas? It's like zero. So how far off are we now? So, okay, orders for durable goods were lower than they had been in 2005, foreshadowing a decline in housing production. Basically, you're talking about washers, dryers, refrigerators, stoves, the major components that go into a house. And what those figures include are both domestically produced, made in America, which I don't even think they make any of those things in America anymore, or the major components, the large items, purchase items that are imported. These orders also measure the health of manufacturing orders, a key indicator in the direction of the national GDP. Well, okay, if the United States is not producing these major durable goods, how can we tell how healthy the economy is? I don't know. You tell me. We just lost, it's like a doctor losing their thermometer and their stethoscope and saying, well, okay, go in there and tell me how healthy this patient is. So September 2008, the stock market crashed. Okay, once again, I don't have to review it, but realistically, the big crash was due to the fact that these people that were running the investment firms were making bad investments. They knew their own company was, in real estate, the property really wasn't worth what they were saying it was worth on paper because of the poor appraisals that they were getting, and they knew they were faking stuff on paper, but they kept on investing in other investment firms that they were hoping were legitimate and honest, and that didn't work. So October 2008, $7 billion bank bailout bill. Okay, you heard of the bank bailouts. And so on October 3rd, 2008, Congress established the Troubled Asset Relief Program. Troubled Asset Relief Program. Okay, basically they're giving money back to the investment firms that lost money in the stock market. Does that sound fair? Did you get any money back? I mean, realistically, I lost my entire retirement account. I didn't get a dime back out of it. I didn't see anything. So that was one more bailout that went to executives. We cannot have billion-dollar executives doing poorly. Never, ever, 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 ever. So, they bailed out the executives and the rest of us are sitting here. Okay, which allowed the U.S. Treasury to bail out troubled banks. We'll cover a little bit more of that later. Okay, the Treasury Secretary lent $115 billion to banks by purchasing preferred stock. In other words, they did a poor job investing. The average investor sold their stock saying, I'm going to get out before I lose everything. And then the U.S. government says, we'll buy your stock that everybody's selling. So now we've got the U.S. government investing our taxpayer dollars with investors that have already proven they don't know what they're doing. It also increased the Federal Deposit Insurance Corporation limit for bank deposits to $250,000 per account. Okay, and allowed the FDIC to tap federal funds as needed through 2009. I wasn't really aware of this one. I always thought it was $250,000, but I'd have to look and find out what it was before. But in 2008, an increase to insurance to cover $250,000 for every account. And we've heard news of this administration. A couple of banks failed, and the administration made a promise saying no depositor in those banks will lose a dime. So, who's covering this? This is covered by insurance from insurance companies, and it has all these regulations that says the bank has to keep X amount, I don't know what it is, 20% of your deposit on hand all the time, and they have to pay this insurance. And anyway, there's a lot of laws covering that, and how we can have a president or an administration ignore these laws and say, I know there's laws that exist, but I'm not even going to bother reading them. I'm just going to, make sure none of my friends lose money. Okay, February 2009, the $787 billion stimulus package. Okay, this is 2009, so the crash started actually in 2006, and we got to realize this was 3 years later. They're still trying to get out of the ditch. Congress passed the American Recovery and Reinvestment Act. Sounds really good. American Recovery and Reinvestment Act. The $787 billion economic stimulus plan ended the recession. It granted $212 billion in tax cuts. Did any of you see any of those tax cuts? So basically, who got tax cuts? And $575 billion in outlays. Did you see any of that money? You know, this is all going to the major banks, not, you know, your small bank in your local town or your small bank in your local city. This is going to the major corporations, including $311 billion for new projects such as healthcare, education, and infrastructure initiative. So basically, you know, this is Obama. They're investing more in healthcare and more in education. By the way, how has these investments, $311 billion invested in education, how is that looking today? You know, how did the government use $311 billion for education, and what do they have to show for it today? And the same thing as in healthcare. I mean, realistically, we see this time and time again. The government starts investing or handing out money to these sectors, and why is it when the government hands out money to these sectors, the prices just skyrocket? Happen in healthcare. Government gives Wi-Fi providers billions of dollars. What do? They all doubled the fees we got to pay. They doubled them all at the same time. You know, the same way with cell phone service providers. Government gives them billions of dollars to, you know, help spread 5G all over the country. Basically, what happened? As soon as they got the money, they raised the monthly fees. I mean, this is a cycle we got to stop. Okay, on February 18th, 2009, Obama announced a $75 billion plan to help stop foreclosures. The Homeowner Stability Initiative was designed to help 7 to 9 billion homeowners before they got behind in their payments. Okay, a good plan. Did they really need it? I mean, basically, did the American taxpayer have to get involved and give banks money that they would have lost, you know, lowering their interest rates from 6% to 4% a year? I mean, realistically, you know, I remember a parable in the Bible to where this man was working for a guy that loaned out a whole bunch of money and stuff like that, and he went to these people and says, "Okay, you owe me 100 barrels of olive oil," and the guy says, "I don't have it." "Well, give me 50 and I'll write off the rest." Okay, and then he went to another guy that had borrowed something else, and he said, "Okay, give me half and I'll write off the rest. Give me." And in the Bible, he called that guy a wise man. I mean, he got something back, and it helped the whole situation. So, basically, sorry for the interruption. I didn't look at the time, and 11 o'clock on Wednesdays, they have they test the, air raid sirens or warning sirens, tornado warning sirens. And kind of reminded me of something I should just mention real quick here. Thoughts and prayers for the people in Maui. Hopefully they can recover. If they're going to get any government assistance, hopefully it's done fairly and they focus on the people in Maui. And realistically, that island has quite an unusual problem, being that most of the people that live there have homes there and everything else are direct descendants from the Hawaiian people. they're facing all kinds of problems. Some of the stories I've watched a number of videos. A major problem there is before the flames even died out, the real estate agents and investors were calling the people, trying to force them to sell their land. And I don't know if you got thoughts and you want to share your thoughts with the National Association of Realtors, look them up on the website, send them a letter, tell them, what's your thoughts about real estate agents calling people, in that situation. And if you are a resident of Hawaii, you might want to get in touch with your state legislator, your state representative there, and tell them your thoughts on the situation. Okay, so get involved. Tell your representatives what you think. I mean, this is an educational video, so you can get kind of caught up with what happened in 2008, and we're watching another housing crisis on the horizon. You got ideas. You think something might work. You got an idea. You want your legislators to consider. Hey, send them an email. Okay, it's easy enough to look up on the internet. So do your civic duty and share your thoughts. Okay. Now, this all started in 2006, and in March 2009, Making Home Affordable launched. So it took 3 years for our federal representatives to start coming up with these ideas. This is why it's important. If you got an idea today, share it with your legislators and lawmakers to get the best laws passed, and our tax dollars are used in the most effective means. Okay, this all focused on homeowners to avoid foreclosures. The program generated more than 1.7 million loan modifications in its lifespan. Now, don't forget, there were 7 to 9 million people facing foreclosure. So this is maybe 20% of those loans were actually. So we got to look at it from two ways. There were a lot of people back in 2006, 2007 that were getting loans that really were not qualified to get loans. That's what people say caused the major recession. And there were people who just got caught up, were given bad information, and the government has passed a number of laws that give, I'm supposed to know the names of these laws, but basically there's a law that says when you go and get a loan, within 3 days you get the whole outline the lender gives you that explains exactly what you're getting into in the loan, how much it's going to cost you, what the interest rates are, if there's any interest rate changes during the life of the loan, and all of this stuff. It's all standard forms, so everybody in the United States gets the same form, sees the same information, and makes the same educated decision. So the government has worked out a number of programs that are focused on helping the average American home buyer. Do we need more? We could always fine-tune those. And if you got an idea, if you went through the process and something happened to you, let your legislator know what your issue was and your ideas on how to fix it. Okay, so that will basically, this thing gave homeowners who are upside down on their loans, basically in review, interest rates on their mortgages shot up. Their homes were losing value, and now, the home that they bought for $150,000 was only worth $100,000, and they really couldn't afford to make the payments with the higher interest. So they restructured those loans, they refinanced them to take advantage of lower mortgage rates. There's nothing wrong with that. It still cost them money. They had to pay loan origination fees and all this other stuff. Cost them a couple $1,000s. I don't know if there were federal programs that helped paid those application fees and all the other stuff, but there was the program, the homeowner affordable refinance program that helped people out. So that's basically, you notice it says modification in its lifespan. Okay, that went away. Do we need it again today? I don't know, but how many of the people do we have in Congress today that are going to go back and read this stuff and find out how they fixed this problem between 2006 and 2009 and go, okay, here's the best ideas. Basically, if we got to go back and we got to read this history and we got to tell them what to do, that's what needs to be done. Okay, let's not drop the ball. Okay, August 2009, Obama asked banks to modify loans. Okay, by August, foreclosures kept mounting. This is from 2006 all the way 3 years. Dimming hopes of an economic recovery, banks could have, but didn't prevent foreclosures by modifying loans. Why? Because the way the initial system was set up with the mortgage insurance, the banks were collecting 3 years of mortgage payments or 2 years of mortgage payments. So they were collecting X amount of dollars per month. So the banks collected that. Then, if they fell behind on their payments, the banks filed for foreclosure. And it cost the banks, I'm just estimating, about $4,000 would cost the bank to foreclose. Now, when they foreclosed, the bank went up for auction, and in most cases, the bank that foreclosed was the only bank that would bid to buy the house back, so they got the house back for pennies on the dollar, and then they sold that house as a foreclosure for the market value of the house at that particular time. If the house was in good condition, they got back the majority of the money. Now, there was mortgage insurance that covered the banks that they got back the majority, up to 80% of the value of the loan. If you do the math, the banks were actually making more money by going through the foreclosure process and then reselling the house as a foreclosure. That's just the way it worked out. So this law, the laws that they were passing, did not benefit the average American homeowner or the person that was facing foreclosure. Those laws, of course, favored the banks, the investors that made the mistakes that caused this whole mess. And that's something we really need to examine and straighten out. Okay, so basically, the foreclosure process jumped up 30% higher than in 2008. So they passed all these laws. They gave all this money to the banks and investment firms to help the average American homeowner who was in trouble. And what happened? It got 32% worse than the previous year. So did those laws really help? Or did it just cost the average American taxpayer a whole lot of money and benefited the executives in those investment firms that initially caused the whole thing? So we really got to dig into this history of this and find out, okay, how are we going to pull out of this recession by benefiting the average American homeowner and not benefit the people that caused the situation to happen in the first place. Foreclosures continued rising as more adjustable rate mortgages came due to higher rates. Okay, we were just looking at 2009. Okay, you do the math. In 2006, 2007, people got adjustable rate mortgages. The banks really worked hard to give them a low interest rate for the first 3 years, and then after 3 years, it adjusted to what the rates were. Basically, the government did the right thing by lowering the interest rates. So when it came time for them to readjust on the adjustable rate mortgages, the hit was not too bad. But here's the thing. I didn't read the loan agreements that they had because it's calculated on the loan index plus a number of points. Were these banks taking advantage of that loophole and adding on 2% interest, 4% interest? I don't know. I didn't see them, but this is really something I haven't seen any government agency or legislators or anybody look into it. And this is something that raises a question that should be investigated. And just as a side note, most of the foreclosures were from Arizona, California, Florida, and Illinois. So, okay, take that for what it's worth. In October 2009, unemployment peaked at 10%, the worst level since the 1982 recession. Almost 6 million jobs were lost in the 12 months prior to that. And employers were adding some temporary employees, but they were, temporary services, part-time employees, and all their stuff. Employers were afraid of another crash. They had little confidence in the administration and what Congress was doing to fix the problem. That's one thing we need to avoid. I'll tell you right now, the major cause of this real estate recession right now is low confidence in the administration and lawmakers in general. So what we got to do is we got to tell those lawmakers what we want done to fix this situation. But the fields of healthcare and education continued to expand. Okay, how good is this education thing doing now? I don't need to go into the details. And the fields of healthcare. Okay, basically, with this recession that we've been seeing and the inflation we've been seeing for the last 2 years, what has gone up more than anything? Healthcare. Anyone who's gone to see a doctor or a dentist, or even taken their pets to a veterinarian, has seen increases well and above the inflation rate. Why is that? Well, that's exactly where the government thought it was best to invest in. So, does that make any sense? Okay, one reason the recovery was sluggish was the banks were not lending. Lending was down 15% for the nation's 4 biggest banks. In other words, the people that were holding up the recovery were the same people that caused the recession. And you can look at the names. These banks cut their commercial and industrial lending by $100 billion. Loans to small businesses fell sharply during the same period as well. Anyone who's ever owned a business of any type or size knows how difficult it is to get a business loan, to purchase real estate, to expand, to hire new employees, whatnot. Interest rates are much higher than what you see on houses. Usually requires at least 20% of money out of your bank account, out of your pocket, to secure a loan. And guess who caused this? The same people that caused the recession in the first place. So we see it keeps on pointing back to the same people. Okay, the bank said there were fewer qualified borrowers thanks to the recession. Businesses said the banks tightened their lending standards. But if you looked at the 18 months of potential foreclosures in the pipeline, it looked like banks were hoarding cash to prepare for future write-offs. In other words, banks were sitting on $1.1 trillion in government subsidies. So, were they sitting on that money, or did they pay it off as executive bonuses? Anybody ever look into this stuff? I mean, these are the type of things that we need to question, and we need to write our representatives and say, guess what? We need an answer. We know this happened years ago, but we do not want to see another bill passed in Congress to help out companies that cause problems. And we do not want to see the executives of those companies rewarded by the government for making bad decisions. We got to make sure that does not happen again. Okay, people are still angry about the $350 billion in taxpayer dollars that were used to bail out the banks. Many people feel that there was no oversight and that banks just used the money for executive bonuses. Okay, it's like, tell us something we don't know. And that's the major problem, is the government hands out money without the proper oversight. That's got to stop. It's got to stop right now. It's got to stop. It should have stopped back in 2008 and 2009. The government should have looked at, is there a way to monitor these situations? Oh yeah, there is a way. They passed a law saying that your bank has to report any transaction from $600 and above to the Internal Revenue Service. That's your account. What about these millions and billions transferred in between these major investment firms that messed up the whole country back in 2006, 2007? Anything being done about that? Okay. Another article that's kind of tried to compare what happened back in 2008 to today, and has a couple of good points. The bad, subprime lending has increased 63% since 2010, and banks lent out over $4.18 billion to subprime mortgage borrowers. So today in 2013, they got 63% more subprime loans today in 2023 than they did in 2010. So basically, with all these laws, with all these bills, with all the money they gave to these investment firms and banks, what are they doing? Did they learn from history? The only thing they learn from history is how to repeat it so that they can make more payments to their executives. Okay, the ugly. Americans are $14 trillion in debt, and non-mortgage debt is $1.5 trillion more today than it was in 2008. Okay, let's break this down into normal, simple, everyday language that people can understand. Okay, basically, we know the banks that caused the housing crisis in 2008. What are those banks into today? Look in your wallet. You probably got a charge card, or maybe two or three, that has the name of these banks that caused the recession in 2008. So they've shifted their lending down from, you know what, why should we make loans on houses for 4%, 5%, 6% interest when we can loan it out on charge cards for tens of thousands of dollars? I mean, realistically, if I looked at my wallet, I probably got credit cards that add up to over $100,000 worth of credit. I don't owe a dime in any of them. I pay them off every month, but how many Americans do that? These banks are shifting from home loans to credit card loans at what? 18, 20, 24%? I mean, come on, let's not be foolish. They're making a lot more money on higher interest rates, and they're repeating the same process, but today they're using charge cards instead of home loans. Okay, what are they going to do if people default on their charge card loans? Are they going to come and repossess their latest Apple phone or their big screen TV or their shoes or $100 jeans or $200 sneakers that they bought? I mean, come on, let's get real. Basically, this is unsecured loans, and they have absolutely no recourse on recovering it. But that's exactly what they did in 2008. At least in 2008, they said, well, okay, this house that appraised at $150,000 is really only worth $100,000. At least they had 60-70% of assets that they could recover. With the charge cards, it is absolutely zero, zip, nothing, nada. So they're putting us in a worse situation today than they did back in 2008. And we're all sitting here just watching it happen, la-di-da. Oh, don't worry, somehow it'll all turn out okay. But we know what's on the horizon is the government is going to watch these banks fold on their bad loans on credit cards, the people that really shouldn't have them, and then they're going to take the money from us that don't owe any money on credit cards and give it back to the banks so the banks don't lose anything. The banks don't lose anything. They're not going to learn the lesson that they should. Actually, I'm not even going to say it. They don't even belong in business. Okay, young borrowers face greater challenges to home ownership in 2020 as student loan debt has reached $1.51 trillion since 2008 levels. Okay, so basically, the government invested a lot in education. And the cost of education since then has shot up. It probably tripled or quadrupled. And is this all a government plan to drive everybody in debt? They invested in education that has gone up way above inflation levels. Medical, which has gone up way above inflation levels. And, we got student loan debt, and we hear about the president wants to forgive student loan debt. That is the dumbest plan I have ever heard. The only way that these lenders can lend out more money on student loans or for houses is to collect the monthly payments and use that money to borrow to the next person. If that money is not coming in, that means these banks do not have money to lend out. If you notice and look at the timing, the moment Biden suspended payments on student loans, what happened to the interest rates? Interest rates shot up because of the simple fact that, guess what? There's less money to loan out. It's simple economics. If student loans are forgiven, how many years? It took, 3 years before we started seeing a recovery on the 2008 housing crash. If forgiving student loans and saying the banks aren't going to get that money, those payments anymore, what happens? Basically, it's either the taxpayers are going to pay those student loans, or if the banks don't get reimbursed, it means that the banks aren't going to have any money to loan out. Either way, it's a poor choice. Okay, well, most debt types lower delinquency rates than 2008 auto and student loans have not. Both have higher delinquency rates now than they did prior to the recession. Okay, so basically, housing, there's fewer foreclosures and all that stuff. We all know that. Because of the laws that they implemented for home ownership and loans, lowered the amount of foreclosures down to practically nothing. Oh, now we've got all these people going out and getting student loans and going out and getting car loans that don't have the same laws. And you know, these banks are just creating a problem in a different area. And we're just sitting here watching it happen. So we got to get involved. We got to start telling our representatives, you know, we need new laws. Well, that's all I got for today. I wanted to produce something that took a look at the 2008 housing recession, what caused it, what great plans the government came up with to solve the situation, and actually the timeline it took to actually solve this problem. So let me recap. It took the government a couple of years to even notice there was a problem. It was like, if we ignore it, we'll let it go away. The people that really benefited from the government subsidies and the bills Congress passed were the same people that caused the problem. And it took the government, 3 years before they started seeing any results? So we're just starting to see this recession now. Can we really afford to wait another 4 to 6 years before we start seeing a recovery? Come on, let's take a look at history. Let's learn from history. And let's admit it, our people in Congress aren't going to look at what happened, what they did to solve the problem, and how to fine-tune it. It's up to us. So, don't forget to like, don't forget to comment, leave your comments, and if you got a really great idea that you think will work, get a hold of your representatives both in the state and on the federal level. Don't forget to share, because this is information. The more people we get involved, the better chance we're going to have of actually having the government listen to us. And don't forget to subscribe, because I'm going to be going through, I'm considering doing a couple of videos on real life experiences I had sitting in a conference room at a table with some really poorly qualified buyers and lenders, and how they actually tried to work out deals just to close the deal and get paid their commission. I tell you, I went back, talked over these situations with my broker, took his advice, and just went through a cancellation mutual release. We're better off working hard to put the right buyers in the right house, and that's what real estate should be all about, not just trying to earn a commission. So that's the way I run my business, and I'm not about to change.